This is Will McCauley with Intellect. I'm here to discuss our views on the crude oil market for this week. At Intellect, we remain bearish crude oil prices. Specifically, we're looking at the July 2019 contract. We've had a short position on for the past 2 weeks. However, we feel the short-term news cycle has outweighed the longer-term fundamental oversupply situation that we see in the market, and the trade has moved against us. Currently, we're down 6.3% year-to-date, having stopped out a couple of times this year as the short-term technicals and news has moved against us. We have a self-imposed stop loss of 5%, so if the market continues to run, we will again stop out of our short position. For 2018, we were up 22% on an unlevered basis based on our crude price views. The second thing that we do at Intellect is we forecast U.S. stock builds and draws each week. So for the week ended Friday, the actual build in the United States was 3.6 million barrels. That compares to our forecast of 3.4 million barrels and the market's expectation of 2.4 million barrels. Coincidentally, the 5-year average is also 3.6 million barrels. We at Intellect have a strong track record of predicting both stock builds and draws in the United States. And again, we publish those views every week prior to the release. Specifically looking at our price forecast for the July 2019 contract, we expect that contract to settle somewhere between $44 a barrel and $50 a barrel. That compares to where the market is currently trading around $53.85. So we still maintain a view of some material downside in the July 2019 contract. Shifting to the factors, the 6 factors that are the backbone for our bearish view. The first is the United States dollar, which we've discussed previously. It continues to be strong. It was up a little less than 1% last week, and it's up 8.7% over the last 43 weeks. There's a strong inverse relationship between the United States dollar and crude oil prices. As the U.S. dollar rises and remains strong, crude prices fall and remain weak. As the dollar remains in a first quartile strength position, we expect an overhang on crude prices until that median reverts towards the longer term average. The second factor is the forward curve shape, which is in contango. We've been in contango since the end of October or early November. Contango markets are a bearish overhang on crude price as well. The typical duration of a contango or a backwardation market is roughly a year to a year and a half. So we still see a period of time where this contango overhang will remain on the market. The third factor is United States demand, which was down 120,000 barrels year on year. It's down about 0.8%. The fourth factor is lease to commercial stocks, which were up about 800,000 barrels week on week. The fifth factor is U.S. exports were down sharply. They were down 3.5 million barrels week on week, pointing to weak international demand for the lighter crude slate that the United States is producing. And the sixth and final factor is refinery utilization, which was down sharply last week as well. It was down 4.9 million barrels week on week. Again, we're in a seasonal refinery turnaround period, so we would expect a drop. However, this was larger in magnitude than we anticipated. So the duration and the magnitude of the declines during the turnaround season will be significant to see what the oversupply situation looks like as we progress through 2019. For our full view on crude oil, including some bullish points and our views on both natural gas and power, please visit our full report at our website, cintellect.com. Thank you.